So welcome everybody. We're here for our discussion on Ralph G. Hawtrey. And our guest today is David Glasner. We've just talked with him briefly before he came on. Primarily, he's maybe a visible presence on the internet because of his Uneasy Money blog, which I would like to actually pull it up right now just because it's so beautifully put, the way he describes it. It's a commentary on monetary policy in the spirit of R.G. Hawtrey. And I believe what we're here to talk about today is both to jump into some of the particular questions, discussions we had as we were trying to understand not only the specific writings of Hawtrey in the text that we read, The Art of Central Banking, but also sort of infer lessons and sort of major contributions and strands of thinking that have not been forgotten or underemphasized. And I think that's also something you've just emphasized in the pre-discussion. That's something we'd like to sort of bring some attention to. Lessons for today, lessons for us and as a generation to take on in thinking about money, thinking about economic policy, and let's see where Hawtrey takes us. So maybe I asked David to, in my email exchange, to maybe start, and that's also the paper that's been circulating. Thank you, David, for circulating that. I've been sharing it with other members of the group, to talk a little bit about what got you interested in the first place in Hawtrey, and also maybe about your specific sort of intellectual formation at UCLA as a graduate student. And that's also what you're covering in the very nicely written introduction that you shared with us. So maybe just we've all read it. So if you'd like to sort of highlight some of the things that stand out to you, we'll take the discussion from there.
Okay, great. Thank you, Jay, for that introduction and for inviting me to be here today. Let me just, before I get started, I'll say that I see a familiar name that I now can attach a face to, Wynne Monroe, who has been in touch with me periodically for the last couple of months on Twitter. And we actually just had a brief Twitter interaction a half an hour ago about the relative merits of Hawtrey and Friedman and Schwartz, which is, I guess, one of my little I can't think of another word, so I'll just say the one that's in my mind, obsessions. But I guess that's a fairly innocuous obsession. So it's good to be able to attach a face to Wynne Monroe's name now.
Nice to see you, David. Always good to have a little exchange about the Great Depression on Twitter.
Right. Okay. So may they continue. All right. So let me just start by saying that often when you become very interested in another scholar or intellectual and somebody that influences you, the reason that you find that person, in this case Hawtrey, interesting is because he somehow really changes your way of thinking. And so that reminds me that Hayek once said about Ludwig von Mises that Mises subjected him when he read, I think the book that he read by Mises was Socialism, that was a kind of intellectual shock therapy for Hayek. So in my case, this may sound a little self-centered, but the reason that I became interested in Hawtrey was because he was saying something that I already more or less had arrived at myself. Not that I arrived at it myself, it was something that I learned from one of my intellectual mentors or heroes, Earl Thompson at UCLA, who had introduced me to the Hawtrey Cassell. We often leave Cassell out of the picture, but he certainly deserves more or less equal recognition, even though we're not going to talk about him today. But it was the Hawtrey-Cassell explanation of the Great Depression that Earl Thompson had taught me when I was a graduate student, and which I had never heard until I was taking his graduate macroeconomics class. That was actually the second time I didn't take it, but I sat in on all of his lectures. I had originally taken that course from Axel Leyenhoef at UCLA. At any rate, so it was Earl who basically came up with the theory that the Great Depression was caused by an increase in the demand for gold after gold had been demonetized during World War I and in the early 1920s when gold standards was being restored. That generated an increase in the monetary demand for gold after it had earlier been demonetized, and that was meant that the value of gold would increase, and under a gold standard, if the value of gold is increasing, that translates into deflation. And that was his explanation of what caused the Great Depression. And in addition to that, he also critique the price specie flow mechanism. And so these two ideas, that the Great Depression was caused by gold appreciation, and B, that the price specie flow mechanism is an inaccurate representation of international adjustment under the gold standard, were, to me, those were the ideas that really changed my way of thinking. Up to that point, I was sort of kind of agnostic about the exact theory of the Great Depression and about whether I was a monetarist or certainly not an Austrian, but I had sort of some Austrian sympathies. But it was actually Earl Thompson who sort of really changed my way of thinking. That was sort of the experience of intellectual shock therapy that I underwent as a graduate student. So Hawtrey didn't figure into this. Earl was pretty knowledgeable about economic literature, but I don't think he had any awareness of Hawtrey or Cassell. So it was only much later, 10 years after graduate school, when I was writing my book on free banking and monetary reform, that I began to delve into Hawtrey as doing sort of background research. I had come across Hawtrey's name, of course, here and there as a graduate student. He was still quoted from time to time or referred to. But I began to take notice of him when, again, for other reasons, I read the work of Harry Johnson on the monetary approach to the balance of payments. And in one of his essays on the monetary approach to the balance of payments, he referred to Hawtrey frequently as a kind of early anticipator of the monetary approach. And he cited him, and I think he mostly cited his book on the gold standard. And so when I was doing research for my book on free banking, I read Hawtrey's book on the gold standard. That was like either the 4th or 5th edition of the gold standard. And he went through in that book his interpretation of the Great Depression. And it was basically saying everything that I had heard from Earl Thompson about A, the Great Depression, and B, the idea that the price specie flow mechanism, which says that monetary adjustment under the gold standard takes place because gold flows equilibrate price level differences, that was all wrong. It also led me to the work of McCloskey and Zecher on how the gold standard really works. So those are like seminal papers, or Harry Johnson and the McCloskey-Zecher paper that I keep coming back to and citing probably almost more than anything else in my book, the book that's going to come out maybe next year, and that proposition that the price specie flow mechanism misrepresents how monetary adjustment took place under the gold standard. And Hawtrey had that all cold. And so he basically, everything that's in the monetary approach to the balance of payments, like at a theoretical level, Audrey already explained that. So even though Harry Johnson referred to him, he still didn't give him enough credit for anticipating everything that was in the monetary approach to the balance of payments. And nobody ever said anything about Hawtrey or Cassell in regard to the Great Depression. Even Pat Deutscher, who I mentioned to Jay, who wrote an outstanding book, which I encourage you to read, R.G. Hawtrey and the Development of Macroeconomics, does not emphasize sufficiently his work on the Great Depression. So that was became a very troubling observation to me, that Hawtrey was just somehow, it wasn't deliberate, but it was just something that was so important was just forgotten. And then after I wrote the book, or had finished, I happened to meet my friend Ron Batchelder, and I told him about Hawtrey, and then he came back and he told me about Cassell, and that's where the two papers that we wrote together about the Great Depression came out of that interaction, where we realized that there was this literature that the profession had just not recognized. And then it was sort of rediscovered in the late 80s and early 90s through the work of Peter Temin on the Great Depression, and then Barry Eichengreen also wrote a lot about the Great Depression, that sort of rediscovered the role of the gold standard and deplorable actions of the Bank of France and the mistakes of the Federal Reserve System. But Hawtrey and Cassell were sort of not mentioned. At least if they were mentioned, it was sort of casually, without giving them proper acknowledgement and credit for, and not only explaining the Great Depression, but anticipating it ahead of time and warning of exactly the consequences that would result if precautionary measures weren't taken, central bank cooperation to limit the demand for gold. All of those things were mentioned ahead of time, and they were brought to the attention of policymakers. There was actually the Genoa Conference, which Audrey was the key instigator of, and Cassell was also involved in that. And it was specifically designed to avoid the catastrophe. But in the end, the message wasn't taken. So anyway, so that accounts for my interest in and in a certain way affection for Hawtrey, the sort of injustice of his lapse into obscurity. So those are all factors that sort of in a way intellectually, in a way emotionally, sort of have drawn me to Hawtrey. So I've gone on here for perhaps longer than I should have. So I'll just close by saying that my knowledge of his work is far from exhaustive. He was like a prolific author, and there's still a lot more to discover in his work. I think he wrote a book. He wrote the vast majority of his work was on monetary theory and policy. He wrote a famous paper which earned him, which did not earn him plaudits from the profession as a whole, about what's called the Treasury view, that fiscal policy cannot have any positive effect, or public works spending or public spending in general cannot have any positive effect on employment. And that generally did not detracted from his reputation, even though I think he's been downgraded unjustly because of that, because the paper isn't as bad as it's made out to be, I think. Not that I would say it's a bad paper, but I think it was not totally accurate, even though it might be. There is a point, but I don't want to belabor that. He also wrote an interesting book, which I haven't read, called The Economic Problem, which is a kind of economic textbook. And that would give you a much broader view of his work as his thinking as an economist, and even as a public intellectual. But anyway, I think I've gone on long enough, so why don't we start sharing our ideas. So
that's great. So I'm sure that everybody has a bunch of things to jump in on right now. two things that I just want to sort of help at the beginning still to frame the conversation. There's two things in your paper that stood out to me that I would like to sort of just throw out there, but then we'll move over to others as well to sort of maybe bring points and ideas to the table. But the first thing that was super interesting to me, and I'm glad you basically mentioned most of these things in your quick contribution, but I think I would like to emphasize him being a monetary economist, and in one of your blog posts, you also mentioned Badgett, who we are also studying. I think there's some sympathy and some relationship that they have, and that is, of course, mostly related to the instability of credit, which actually is something that most economists have trouble with fully taking on in the way that Hawtrey treats it. And an associated problem that you also just mentioned is the coordination problem. That is, in the case that you've now mentioned, a monetary coordination problem around of central banks to sort of limit in the Geneva Convention the use of gold amongst many different central banks, the top central banks, to stabilize the system. But this is also a coordination problem that happens at the lender of last resort level, like when there's a crisis, the central bank plays a similar function. So I'd like to just start the conversation with these 2 points that are central to your paper and also to our conversation that we've had with respect to the reading we've had. But maybe I just hand it over to others just to see if other things fit to that point I've just raised. Before, David, you take this. No? Okay. David, why don't you just emphasize these 2 points that are also in your paper? I'd like to hear your thoughts more on that.
Okay, so I think there is a clear relationship between Badgett and Hawtrey, and I think Hawtrey certainly understood the importance of a lender of last resort or of a central bank. I don't think he named his famous volume, The Art of Central Banking, because he thought central banking was not a vital institution. So I don't know that I've seen a lot of, I can't recall specific references right now by Hawtrey to Badgett. So let me just respond this way. My reading of Hawtrey is a little bit different on the role of the lender of last resort, is different from my reading of Badgett. The way I understand Badgett is, yeah, you need to have this lender of last resort available in crisis periods when the interbank credit system is freezing up because there's general distrust. Everybody's afraid that if they lend to another bank, that bank isn't going to be able to pay back. And so you don't want to incur liabilities that could impair your own credit. That the lender of last resort doesn't have that issue. On the other hand, Badgett was concerned about moral hazard. At least that's how I'm interpreting it. And so he therefore said, well, yes, lend, but lend at a penalty rate. And I don't think Hawtrey agreed with that, because I think Hawtrey realized that there was a systemic issue of that the liquidity issues or even the solvency issues were not the result of necessarily the result of some bad decisions on the part of the individual bank. They were the result of a crisis, of a systemic crisis. So when there's a systemic crisis, there's no point in charging a penalty rate. You want to reduce the rate and lend at as low a rate as is necessary for systemic stability. And that's not the time to sort of be nitpicky about moral hazard issues. At least that's sort of my interpretation of what Hawtrey would say. Again, I'm sort of attributing to Hawtrey what my, how I look at the problem. I think that's at least a fair chance that that's what Hawtrey himself would have said. I think there's one of my favorite quotes from Hawtrey is from his testimony to the Macmillan Committee, where Macmillan, where Hawtrey was saying, well, the Bank of England needs to cut their cut bank rate. And Macmillan, the chairman, says, well, isn't that a violation of like central bank orthodoxy? And Hawtrey says, well, central bank orthodoxy is like rules at bridge. Sometimes you have to be willing to violate the rules because the circumstances require that. And if the situation is so dire, you have to be willing to give up all your, put all your chips on the table, all your gold reserves, because if you are, that's what they're there for. Otherwise, you have a systemic catastrophe. He expressed it a little more tersely and sharply than I am, but I quoted it a few times in my blog, and I think maybe in some of my papers. But I think that's an important distinction.
Thanks, David. I've just found the reference. I just put it in here. So yeah.
Okay.
We can come back to that in a second, but let's hear from others.
Let me go next here. I've got a couple. I'll maybe not throw them all out at once. I'll save a couple for later. But just start off. Yeah, nice to put a face to a name, David. I really enjoyed reading your blog and our exchanges on Twitter, and I really enjoyed the first chapter introduction you sent around. That was really great. I'm looking forward to the book whenever it comes out. So the first thing I was going to say, I guess, is kind of more of a comment on what was kind of just being discussed. And then after that, I have kind of a related question that's maybe not specifically about Hawtrey, but about some of the kind of topics that are discussed in the Art of Central Banking. So the comment is kind of on this question about Badgett and the relation of Badgett to Hawtrey. I mean, when I was reading the Art of Central Banking with the group, I really got this sense too that there's this kind of, intellectual lineage there. And he does, he does in the Art of Central Banking cite Badgett actually a fair number of times, I think. But I think the point that you just made is one that really kind of captures an idea that I was kind of wrestling a little bit with here, which is, and I haven't read Badgett, so I shouldn't yet. Maybe we'll do that for the next reading group or something. So I don't want to attribute too much there, but the general sense that I often get of the kind of like Bagehot lender of last resort story is a bit more of a kind of microeconomic, idiosyncratic bank risk kind of one, where a bank runs into trouble for some reason that doesn't seem to just be bad behavior from the bank, and the central bank then offers some help. Well, Hawtrey seems to be kind of talking about it from a more macroeconomic perspective, where the lender of last resort is still this essential quality of the central bank, but that it's not just this kind of microprudential aspect of it, but it's rather a systemic one, and that may be why this concern about moral hazard and this kind of thing is less present. So that was really helpful for me and kind of helped me kind of crystallize this idea a little bit. My question was going to be, so one of the things that kind of Hawtrey really emphasizes here on the Great Depression is this idea that there's this huge kind of increase in demand for gold when countries are looking to return to the gold standard after World War I. And I guess one of the questions I had was kind of, why was this just a problem then and not before World War I? And the kind of two things that came to mind to me were, one, that Hawtrey mentions that bimetallism was pretty popular still until the late 1800s. And so perhaps kind of global central bank demand for gold was lesser because it was also distributed amongst, demand for silver. Or perhaps it's just the timing with the kind of industrial revolution and, economic activity and money demand increasing in the mid and late 1800s. And so there's just more need for demand and currency and this kind of thing. But yeah, so, that's kind of one of my questions is why is this kind of global increase? I mean, in some sense, did we ever really have a modern global gold standard? Was it ever kind of sustainable in the pre-World War I period? What was different in the kind of interwar period?
Sure, I think that's a really good question, and I've thought about it to some degree, but it's worthy of further thought and for someone to do research on. But here's my take. I think what you had in the 1870s was a transformation of the international system. Up until around the early 1870s, the gold standard was basically a British institution. And what you had was either bimetallism or silver standard, and bimetallism was generally a de facto silver standard because of the relative legal conversion rates caused this silver to be the de facto standard in the bimetallic countries. So what happened in fairly quick succession was the United States, which had been on a greenback standard during so the Civil War, established a gold standard, and there was a gradual appreciation of the dollar relative to gold, and in like the early 1872, it was formally linked to the gold standard. At the same time, Germany, which came into existence as a nation state in early 1870s after the Franco-Prussian War, I think. My European history is not all that good, but I think that sort of resulted in the creation of the German Reich. The First Reich. So they decided that they were going to switch from silver to gold. So that created another increase in the demand for gold. And then, like what it was called the Latin Union, that was France. Who were the other? It was primarily France, but there were 2 or 3 other European countries that had Latin languages, I think, and they also, I forget the exact mechanics of it, but they also switched from bimetallism to gold. I think after the US and Germany switched, staying on the silver standard meant accepting inflation. They didn't want the inflation, so they went to gold. So that caused increasing inflation under silver and deflation for gold. So you had that shift in the 1870s. By 1880, late 1870s, all the formerly silver standard or bimetallic standard countries had all effectively moved over to gold. So it was sort of a spontaneous network effect where countries were going from silver to gold. And then that resulted in a long period of deflation in the 1870s up and through the early 1890s, when there were these big discoveries in South Africa and in Alaska that reduced the deflationary pressure. The first Great Depression was supposedly from 1872 to 1896. It was a period of growth, so the Depression referred to falling prices. So that is, but then from 1896 to World War I, in terms of gold, there was actually a mild inflation. And there was this big agitation in the United States for switching to the free coinage of silver, because the debtor interests were afraid of the deflation that was caused under the gold standard, and going to a silver standard would relieve that pressure because they could pay back in inflated dollars. So that was that whole big conflict in the United States about the William Jennings Bryan Cross of Gold speech. That was all to relieve the debtor classes from the pressure of deflation. So the gold standard from 1880 to the World War I was not exactly a golden, excuse the pun, period, but it had its pluses and its minuses, and certainly the financial and interests and the were happy with it. Then the whole thing collapsed in World War I, and there was almost universal demonetization. So the gold standard no longer exists, although in legal terms it was maintained in a few countries. What happened after World War I was, if you were going to restore the gold standard, you had all this gold that had been accumulated largely in the United States, but there had been, for 20 years before that, there were large increases in the gold stock because of the new discoveries. So there was an enormous increase in gold reserves compared to the earlier period. So it happened, you had this situation where there was so much gold reserves available. If central banks, where the gold reserves were residing, if they got rid of them, the value of gold would plummet. And if they tried to accumulate gold to restore the gold standard, and especially to restore gold coinage, and they were going to have high reserve requirements on their liabilities, that would cause an increase in the demand for gold and you would get deflation. So the course of the behavior of the price level was very much dependent on the decisions that central banks were going to make. If you read people like Robertson and even Ludwig von Mises and Keynes, they were all saying, we're in this situation now where the value of gold is not somehow a given. It depends, the value of gold is going to be determined by what central banks do, whether they demonetize their gold or whether they try to increase their holdings of gold or their monetary use of gold. So it wasn't as if there's this sort of inherited value of gold that you can sort of take as a given, as a starting point. And well, it could go up a little bit, could go down a little bit, depending on sort of circumstances. It became something that the policymakers, the monetary authorities had responsibility for. And they were acting as if, to a large extent, they didn't have responsibility for it. And they were taking decisions without regard to the consequences of their decisions for economic stability. And that's the message that Hawtrey was giving. But some people were sort of nodding their head, yeah, well, sure, okay, I guess so. But they weren't really taking it to heart. And then, you know where that wound up.
So I have a question about the fixed price of tradable goods and inventories absorbing mismatches and imbalances in gold flows. So it makes sense to me that gold flows would not equilibrate via price level adjustments when the price levels are fixed with respect to gold. The flows are happening instead of the adjustments, right? Instead of the price adjustments. So you'd expect the gold to keep flowing away until you run out of gold or do something about it. And then once you run out of gold, that's when the prices would move because you're not maintaining the gold peg anymore. So my question is, how does the fixed international price of tradable goods factor into a non-gold standard world? So the world we're living in now.
So that's a really good question. And I don't know if I can give you a succinct answer to that. But every country with a flexible exchange rate will adopt a monetary policy that will be reflected in its exchange rate. So given the exchange rate and we assume the exchange rates are whatever they are, and for purposes of the discussion, they're fixed for over some short period of time. So there will be at those exchange rates, tradable goods will arbitrage will equalize, want to call it the real price adjusted for the exchange rate. So those prices will be equalized so that there's no advantage to buying an internationally traded commodity in one location versus another location, because after you can do the currency exchange, it costs the same. It costs the same amount. So at that point, the only thing that monetary policy will affect, given those exchange rates, is non-tradable goods prices. So there is some room for price level differences across countries, because even though the prices are in some sense equalized for tradable goods, so there's no advantage to buying a tradable good in one location versus another location. There are tradable, non-tradables whose prices are able to change in one place relative to another place because there's no arbitrage. So monetary policy can have some effect on price levels, even though when there's a non-tradable goods sector as well as a tradable goods sector, even though the prices of tradable goods at any given exchange rate will adjust so that there's no arbitrage opportunity.
Yeah, so that makes sense. So if you have, the price level, obviously, if the exchange rate moves, the price level can move along with that, along with the price level of tradable goods, the relative price level of tradable goods. But then you have this also the non-tradable goods can kind of move in addition to that.
Right. Well, the further complication is that you also have to deal with or take into account expectations of monetary policy and the effect on the effect of expectations of exchange rate fluctuations, which also affect the ability to arbitrage. Like, arbitrage isn't costless. So the more risks there is associated with exchange rate variability, the more costly it becomes to engage in arbitrage. as it becomes more costly to engage in arbitrage, even tradable goods prices may be less linked than they would have been when everybody is confident that exchange rates will stay where they are. So that's a further complication that may even add to the ability of domestic monetary authorities to control their price level, or at least the effect of monetary policies on domestic price levels can be increased as a result of that added costliness of engaging in arbitrage. So anyway, I think I'll stop there because I think I've said everything that I can think of right now, but there's a lot to be said about that.
Yeah, thanks. Everything you're saying makes sense.
So I have a question, just thinking through how we can take some of what we learned to Hawtrey and then expand it to what is happening today, or perhaps to like the global financial crisis or the pandemic crisis. I was just curious on your thought of what would be a Hawtrey reading of what happened and what are the policy recommendations?
Okay, I don't think I can come up with something off the top of my head, but it is worth thinking about. I think the main points to come back to are the necessity to recognize to distinguish between systemic issues associated with financial disturbances, monetary disturbances, and non-systemic issues. So I think that would bring me back to the comments I made earlier about the difference between Hawtrey and Badgett. So I think in a crisis, the crisis is the wrong time to worry about moral hazard. To that extent, I wouldn't push the analogy too far, but because I myself haven't really been thinking really hard about how much inflation risk there is right now. I sort of read some of these discussions on Twitter these days about are we headed for high inflation given fiscal and monetary policies seem to be fairly loose now? And even if they are, should we worry that much about them? So my instinct is to say the risks, there may be risks of high inflation, but I think the risks of not doing something to keep the recovery on track may be greater than the risks of overreacting. But I would be reluctant to invoke Hawtrey's authority for that more or less offhanded reaction. So, but that reminds me that there was a paper on Hawtrey published a couple of years ago, maybe in the European Journal of the History of Economic Thought. I forget the name of the author, but she had a reading of Hawtrey, which I thought was kind of misguided, and she argued that Hawtrey was sort of a very orthodox gold standard austerity guy, basing that to a large extent on his Treasury View, 1925 Treasury View paper. And I think that was a misreading of him. But I suppose if you invited her, and I'm not suggesting that you shouldn't, because she seems to be quite knowledgeable about Hawtrey, even though I disagree with her interpretation. She would probably say, and not that she would be agreeing with it, but she would probably say that Hawtrey would be warning against the danger of inflation under these circumstances, rather than be willing to take some risks.
So I have a question about, oh yeah, go ahead, Raphael. Oh, I thought you were raising your hand. I have a question about the Treasury View, actually, which is that it's interesting because I noticed when reading The Art of Central Banking that he just seemed to be leaving out the possibility of fiscal expansion that might allow the central bank to tighten monetary policy and raise interest rates. Like he seemed to be like, oh, the central bank can do this, the central bank can do that. And he really didn't mention very much about the fiscal authority. So I'm wondering to what extent you feel that the Treasury View is kind of, even though I know you say it's not really representative of most of what he writes about, but kind of to what extent it constrains his other thinking.
Yeah, I don't think I meant to say that it doesn't represent what he talks about. I think he totally believed that fiscal policy has, except under, there is a qualification to that, which I'll come back to. But his basic position was it's that his whole theory of macroeconomic fluctuations was geared or predicated on the bank rate, because that has a nice, neat little theory that the macroeconomy depends on short-term fluctuations, and the macroeconomy depend on the bank rate relative to expectations and the desired inventory holdings of middlemen and traders and wholesalers. And when bank rate goes down, it's more profitable to hold inventories. That leads to increased orders to manufacturers, that generates income to consumers, that generates spending by consumers, that increases desired inventory holdings, and so on. And you can take that up and you can take that down. And so the entire, and this is clearly an oversimplification, but in Hawtrey's model, everything depends on where bank rate is relative to expectations. And if that's the case, fiscal policy, what can fiscal policy do? it can't do anything that you can't already do with bank rate. So, and all fiscal policy does is take spending that would have been undertaken by one section of the community and transfer it to a different section of the community. And that was, he didn't say that, he didn't actually say that it's impossible for fiscal policy or for spending to increase output. He says, yeah, you could do that, but you could have done that with bank rate. If it's possible to increase output because there are unemployed resources, you can increase output and income by reducing bank rate. And there's a bank rate which will lead to full employment, and that's where bank rate should be set. No, it might not be set at that level because of credit implications and a loss of gold reserves. So there could be a conflict between maintaining the gold standard and full employment. Now, Hawtrey also believed the gold under the pre-war gold standard, other countries might be constrained by the gold standard, but not England, because everybody followed the Bank of England. The Bank of England was not only the central bank of England, of Great Britain, it was the central bank for everybody that was on the gold standard. So therefore, in Hawtrey's view, the Bank of England had, what was the French term? I'm not remembering how one of the French politicians said something about inordinate privilege or something, that the dollar had this because they could impose their monetary policy on the rest of the world. So according to Hawtrey, that's the position that the Bank of England was in. So they could call the tune. There would never be a run on sterling because everybody would take the Bank of England's bank rate as their benchmark. And so there was no reason for England ever not to be at full employment. So if the Bank of England can set bank rate to achieve full employment, there's no role for monetary policy. That's my interpretation for fiscal policy. That's my interpretation of the Treasury view, according to Hawtrey.
Can I ask a kind of maybe kind of two follow-up questions? One is on this question about kind of the role of middlemen and inventories in the transmission of monetary policy. I mean, he talks about it a little bit in The Art of Central Banking, but I suspect it comes up kind of elsewhere where he talks about his kind of his business cycle theory kind of more substantially. And I was wondering, first, could you kind of specify a little bit more what exactly the kind of like interest rate mechanism is for kind of middlemen inventory holders? I mean, maybe this is obvious to everyone else, but is it that they finance their inventories and so they are more rate sensitive? And I was thinking, because that potentially offers ways of translating some of this to more contemporary things, like, for example, financial securities dealers who have, who need to finance an inventory of their, financial securities, like during the financial crisis. So that's kind of question one, is pinning down the like inventory and interest rate component. And the second is kind of on this kind of fiscal policy question. I remember, so here I have some notes from reading The Art of Central Banking, and he mentions that, basically banks will prefer to hold government bonds than over kind of other investments, that they're these kind of risk-free investments, and so they, in that sense, like crowd out other investments on bank balance sheets. And I guess I kind of wonder, how does that kind of relate to, his or is it in tension with his kind of theory of kind of central banking and the bank rate being set appropriately? I mean, it kind of seems like if central bank balances offer a rate that's higher than the real return in the economy, they will also kind of prefer to hold central bank balances, for example.
So I think on your first question, I think you basically got it right, that the idea is that the middlemen are financing their holdings of inventories on by borrowing from banks. So a change in the interest rate really has a big effect on their costs of holding the inventories. And that's why he thinks that they are particularly sensitive to changes in the interest rate. And in that context, I think he discusses also the behavior of holders of stocks, like market makers in the stock market, also are in that position. And I think he actually, there in one of the chapters, like he has this chapter, I think it's chapter 2 of Art of Central Banking, on the stock market crash, right? I don't have it in front of me, but I think that's chapter 2. And he argues that it wasn't a stock market, there was no stock market bubble in 29. And then he has this, I don't think it's not only in that chapter, but elsewhere, he discusses the behavior of the peculiarities in these markets, these financial markets. Market makers are holding stocks, and because they're holding them on margin, they're particularly susceptible to changes in the call rate. So I'll just refer you to that discussion, and you can look up for other discussions of that phenomenon. It's not only in that chapter, but elsewhere. Maybe even in the Art of Central Banking, not in the Good and Bad Trade, probably other places. Okay, on your second question, okay, I need you to quickly remind me what the basic issue was.
Yeah, I mean, I guess I was trying to think a little more carefully about, contrasting, comparing his kind of concerns about the fiscal view versus the kind of monetary, preference for monetary policy. I mean, on the one hand, like you said, there seems to be just kind of a preference that the central bank can kind of do it. So, why bother? But there's also this sense in which I have a little difficulty kind of thinking about how public liabilities in the form of, government bonds versus public liabilities in the form of central bank balances interact with the banking system in his view, because he talks about how, in the Art of Central Banking, he talks about how government bonds essentially like crowd out other investments on bank balance sheets. And so I'm trying to kind of understand a little bit more of, why he would see that would be the case for, say, government bonds and not central bank balances or reserves. Like I'm trying to understand, if there's kind of a tension there, or if there's some kind of mechanism or structural aspect that I'm not kind of fully appreciating.
Yeah, I hear what you're saying. I don't think I really have too much to add to what you're saying. I think I just need to have to rely on your own resources. I don't think I have anything to say about that.
Great, thanks.
Great. So we're now at an hour, so I promised I would check how we feel about going on for a couple more minutes. There's been a conversation going on in the chat, so I think there is interest from our side. David, you feel like you have another 10, 15 minutes?
Sure, no problem.
Okay, great. So let's just look at another 10, 15 minutes, and then we'll close the session. And then maybe have you here another time in case there's leftover conversation. So one thing that's coming up right now is maybe Larissa's point. Maybe you want to pose that question right now, Larissa, or is that kind of resolved? I have another question related to my question I had in the chat as well. You want to just ask yours?
I was just trying to think through the implications of the specific moment in time that Hawtrey was developing his viewpoint, and how some of what was the constraints of the reality of England and how middlemen were funded at the time may have impacted then how we would be extending his theory. So on that point, there were two interesting related notes. I had been reading The Public Interest and the Money Interest by Perry Merling, who's someone that we discuss in quite a bit in our reading group. And he talks a lot about Alan Young. And one of the ways that Young adapted Hawtrey's business cycle theory was in noting that in the US, there was a lot more short-term funding, inventory funding through retained earnings, and a lot more dependence on long-term funding. So I think the ability and sensitivity of middlemen to short-term bank rate was therefore different than in London, and that would be one adjustment. And then on the other point, to Wynn's comment on to what extent is there crowding out on bonds versus reserves, I wonder if innovations in, for example, repo markets and in the ways that securities dealers use bonds to actually extend and the amount of lending that they can do, that if that would have changed Hawtrey's perspective on the Treasury view. So it basically extends the ability of fiscal capacity, because today bonds are used in a very different way that they had been in the past.
Okay, those are all good points. And I don't think I have too much to say about different about the different kinds of financing that are available now. I think it's correct to say that Hawtrey's model was very specific to a certain institutional framework. And I haven't thought a lot, there's certainly not enough to really formulate an informed view about how to translate Hawtrey's theory into a different set of institutions. I think that's very much worth doing, but it's not something that I could offer much guidance on. I encourage you to think about it and to try to work in that area. I think it would be really important, but I haven't done enough certainly not enough work and not even enough thinking to really be too helpful to you there. So I don't think I can say much that would be useful beyond that, I'm afraid.
That's great. I would like to just bring up a related issue. I initially sort of posted a quote here into the chat, but maybe on this last issue, just to help us along, I want to just read a quick quote from Currency and Credit in the preface. He has a very interesting point. I would like to maybe just hear about the style that he's proposing. Let me just read what he has, and I have a follow-up question to this as well. So, to add yet another of the legion of books which have been written on currency is an act which almost requires an apology, but extensive and complex as the subject has always been. Every year that passes brings new developments which add to its extent and its complexity. And then he goes on later to say, still less does it exalt any single practical measure as a panacea of currency disorders. Its purpose is rather to present a systematic analysis of currency and credit movements, and especially to avoid that phrase, all things, other things being equal, which it is so fatally easy for theory to step straight from premises to conclusions. And so kind of, this is, I think, something that exemplifies also what you were just saying, and I just want to bring that conversation maybe towards the end now. The thing that you just said struck a chord with me in saying that the principles he's bringing about are not limited to the context of the gold standard. And also, this is also a discussion point we had in the week we discussed this chapter, and I would like to just see if you agree with this point. We were trying to wonder what is his view of this gold standard in particular, and we then kind of I think we came to the conclusion in our discussion that he's actually interested in stability rather than the gold standard. The gold standard is just one means of stability, but the fact that he's talking about credit and emphasizing credit as a means to absorb fluctuation rather than other theories don't have this credit view that helps us think about stability. I'm just wondering if that part also stood out to you in other readings or not, because we're interested in, whatever standard or non-standard we have, but we all agree that we need financial stability or if a stable, somewhat standard, a value or whatever we want to call it, and whether or not that is something that stood out to you, this sort of credit element that other economists are not emphasizing as much, that kind of absorbs fluctuation and therefore delivers stability. And that's something that always is a bit contradictory as well, because you kind of feel like the more there is happening in the financial sector, or more there happens in credit, the less stable the system might be. And that's true as well. There's a little bit of a give and take here. And I think a misunderstanding by a lot of people, including economists, on this issue. I'm just wondering if that stood out to you as well or not.
Yeah, I think you raised good points there. And it's interesting if I were to try to write an intellectual biography of Hawtrey, which not something that I really am thinking about, but if I were to do that, I would talk about the evolution of his view of the gold standard. He, unlike Keynes, who was his friend and long time sort of sparring partner, he favored the resumption of in 1925 of the gold standard at the pre-war parity. Keynes famously opposed that. Hawtrey was one of the experts that Churchill consulted about restoring the gold standard at the old parity. Keynes was consulted, and he had a meeting with Churchill, and so did Hawtrey. Keynes told him not to. Hawtrey said, yes, go ahead and do it. But he qualified that by saying, don't go back if that's going to cause deflation and high unemployment. And he said, I don't think it has to. You will be able to do it without that. And from 1925 to early 1929, Hawtrey's advice was not so bad because the trajectory wasn't down. It was actually mildly upward. There was a bit of deflation, but it wasn't a catastrophic, by any means, a catastrophic deflation, and unemployment gradually went down as the economy expanded. He was not satisfied with that performance because the trend towards full employment wasn't fast enough, and he was upset that bank rate had not been reduced. It was close to 5% for that whole period. However, he supported the abandonment of the gold standard in 1931, and he never advocated after that that the gold standard be restored. He always felt so let me go back. Why did he support going on the gold standard? The reason was he thought it was in Britain's interest, because London was the financial center of the world. And that was largely because the gold standard was centered on the Bank of England. And he thought that if England went back on the gold standard, the centrality of London to the world financial system would be restored. Even though New York was a competitor, he thought, well, still, London is London. And so it was very much a decision based on what was in Britain's national interest. After that, after the gold standard imploded in 1931, he had no reason to think that it could ever be restored, and he never advocated going back on it. He wrote about the Bretton Woods system, and I don't know enough about his later writings to really comment on his in any detail about his view about the Bretton Woods system. I'll just say that he, in his post-World War II period, is notable. He didn't do much original theoretical work, but he wrote a lot about the devaluation of the pound in 1948, which almost alone, in contrast to a lot of other more conservative, arguably more conservative economists like Lionel Lord Robbins, who supported the devaluation. He was relentless in criticizing the devaluation. I won't go into that, but it's worth your while to investigate that discussion. And I'll also give a plug to his last book, Incomes and Money, written when he was close to 90 years old. And it's not, judging its quality is not quite up to his earlier work, but it still has a lot in it that's very worthwhile. And I have written a lot about it on my blog, so I refer you to that in connection with, especially in connection with the 1970s inflation and that whole episode under Arthur Burns. So if you search for Arthur Burns and Hawtrey on my blog, you'll find a number of blog posts that I wrote concerning his interpretation of the post-war events and their implications for U.S. monetary policy in that period. Okay, so anyway, I think that probably is as much as I need to say about that. I hope it responded to everything or almost everything that you were asking.
Well, thanks, absolutely, and thanks for taking the time. And I think in closing, I think we have one final question for you in terms of how do you plan to take forward the blog and also the book? What are your next projects? What can we expect coming out on Hawtrey in the next weeks and months?
Okay, well, I have for the last year, I have been pretty busy at the FTC, and I've also been trying to pull together the various papers that are going to be included in this forthcoming book, which I hope won't be too long. So I have a number of works in various stages of progress that I'm hoping to pick up and either start or finish, maybe even both. But none of them are specifically related to Hawtrey's work. One of the things that I would like to talk about, write about concerning Hawtrey is his testimony, which I alluded to before, to the Macmillan Committee. And in particular, you could also find this on my blog. I wrote a post about it probably in the early teens about the confrontation in the sense that Keynes was, Hawtrey gave written and oral testimony to the committee. This was a committee in 1930 about unemployment in Britain and the general economic situation. And Keynes was like the most prominent member of the committee, and he subjected Hawtrey to some searching questions. And I thought that interaction between Keynes and Hawtrey was very important, and it highlighted some important theoretical points that Audrey didn't address as clearly, although I think he was correct and had, but it didn't come off as well as it might have. And so I'd like to write about that in more detail, although I think the gist of it, if you search for it, I can send you a link to it, and then you can share it. But I thought that was like a very important on a number of levels, a very important interchange between Hawtrey and Keynes. There's also, if you're interested in the relationship between Hawtrey and Keynes, also it's included in the volume that's going to come out. It originally appeared in the Elgar companion to John Maynard Keynes, was an entry on Hawtrey. So it's mentioned in the introduction that I sent you. But an ungated version of that is available on SSRN. If you search for it, or I can send you a link to it as well, about that interesting, somewhat at times somewhat tense relationship between Hawtrey and Keynes, even though Keynes was actually quite generous in some of his published remarks about Hawtrey, even though he at times showed some considerable annoyance with Hawtrey and their correspondence. So that's all I can think of right now about future projects, but if you follow me on Twitter and on my blog, you'll see some other stuff, I hope.
Well, I think on behalf of the group, I can just say that we thoroughly enjoyed talking to you and really appreciate both your own views and how the spirit of Hawtrey, which you just espoused, we are most likely going to pay attention to your book once it comes out. Larissa has actually now just posted the link you just mentioned, so no need to send it to us again. And also, just as a closing comment, since you said putting a face to it, I think you don't have I was searching for a picture of yours, and you had, of course, only Hawtrey, but now I understand you actually look alike with the glasses.
Somebody said that to me. I've also been compared to Larry David.
Yes, yes. Now that you say that, that might be more like it. But again, thank you so much for taking the time. Let's stay in touch. We're all following you on Twitter. Thanks so much for taking the time.
Okay, glad to do it. Take care, everybody.
Talk to you soon. Bye.
Thanks.